Right now, shares of Nuburu Inc. are trading at 65 cents, posting a staggering intraday gain of 18 cents, which is a 37.71% surge. Now, the immediate reaction, the gut feeling for anyone seeing a chart like that, is that a rocket has just taken off and they've missed the launch. The expectation is that some transformative news has just hit the wires and this tiny company is on its way to greatness. But that is not the real story here. The reality is that this 37.71% jump, while visually dramatic, is taking place after the stock has lost over 95% of its value in the last year. This isn't a celebration, it's a potential sign of life from a patient in critical condition. The crucial question we must analyze isn't why it's up today, but whether this is the beginning of a genuine recovery or simply the last reflexive twitch before the flatline. Understanding this distinction is what separates a speculative gamble from a calculated investment, a distinction that is vital whether you are managing your own individual brokerage account or using a service like Schwab Intelligent Portfolios. The common belief surrounding Nuburu is built on a very compelling technological premise. The company designs and manufactures high-power blue lasers. For most people, that sounds like science fiction, but for industrial applications, it's a very specific and potentially valuable tool. Traditional industrial lasers, which are typically infrared, struggle with welding reflective metals like copper. Copper is essential for electric vehicle batteries, charging infrastructure, and countless electronics. It reflects most of the infrared light, making the welding process inefficient and messy. Nuburu's blue laser light, however, is absorbed by copper up to 20 times more effectively. The expectation, therefore, has been that as the world electrifies, Nuburu's technology should be in every battery factory and electronics plant. It seems like a simple, logical conclusion. But the market's reality has been punishing this stock for a reason. The deeper truth is that possessing a promising technology and building a scalable, profitable business around it are two entirely different challenges. For months, the stock has been hammered not because the physics is wrong, but because the business execution, cash flow, and path to profitability have been incredibly uncertain. Let's dissect today's specific market action. A 37% move doesn't happen in a vacuum. The trading volume today is explosive, many multiples of its daily average. This indicates that this isn't just a few retail traders on the Robinhood app pushing the price around. There's significant capital flowing in. This brings up the possibility of a short squeeze. Given the stock's precipitous decline, it's highly likely that a significant number of shares were held short by traders betting on further downside or even bankruptcy. A sudden influx of buying pressure, perhaps triggered by a company announcement or a large order, can force these short sellers to buy back their shares to cover their positions, which in turn pushes the stock price even higher, creating a feedback loop. This is a classic scenario for highly speculative, low-priced stocks and has little to do with long-term fundamentals. It's a technical event, a battle between buyers and short sellers playing out on platforms like the Interactive Brokers trading system, not necessarily a vote of confidence in the company's 5-year plan. This is a very different dynamic from the steady, earnings-driven movements you see in a name like Apple stock or the sector-wide momentum that can lift a giant like Nvidia stock. Looking at institutional ownership filings provides another layer of complexity. While many large funds wouldn't touch a microcap stock like this, any recent changes in filings from smaller, specialized tech funds could be a leading indicator. Has a fund with a track record in deep tech hardware been accumulating a position? Or have former backers been quietly selling their stakes? This is the kind of detail that investors using Fidelity Investments for their online investing should be looking for. The presence of sophisticated capital can suggest a belief in the long-term story, while its absence or flight can confirm that the risks are still too high for professional asset managers. This recent surge could be prompted by one such fund taking a new position, an event that would be disclosed in the coming weeks. Until then, it's pure speculation. The macroeconomy also casts a long shadow. We are in a higher interest rate world, which is brutal for companies that are not yet profitable. These companies, often called cash burn businesses, rely on raising capital to fund their operations and growth. When capital is expensive, their very survival comes into question. Nuburu falls squarely into this category. Any news that suggests they have secured new financing or landed a major contract that significantly boosts revenue would be seen as a de-risking event justifying a sudden repricing of the stock, which is likely a contributing factor to what we are observing. So what does Nuburu Inc. actually do? Beyond the general concept of blue lasers, their core business is providing industrial solutions for welding and 3D printing. Their flagship products are aimed at the electric mobility sector, for welding the copper and aluminum foils in battery cells and bus bars in battery packs. They also target applications in aerospace and defense and general electronics manufacturing. The company came to the public markets via a SPAC, a special purpose acquisition company, a popular method a couple of years ago that has since fallen out of favor. Many companies that used this route were in a pre-revenue or early revenue stage, and the market's initial enthusiasm often gave way to a harsh reality check when they failed to meet ambitious projections. Nuburu's stock chart is a textbook example of this post-SPAC collapse. An investor who bought at the peak based on the initial story has been wiped out. That history is critical context for today's move. It shows how far the stock has to climb just to get back to a fraction of its former valuation, and it highlights the immense risk early investors have already borne. Looking at past performance reports and filings, one would find a consistent pattern of revenue growth, which is positive, but also widening operating losses and negative cash flow, which is the source of the market's anxiety. Their ability to manage their cash burn is arguably the single most important metric for survival. Looking at the investment landscape, this is precisely the kind of security where different platforms and investor types diverge. A day trader using the SoFi trading platform might be focused purely on the intraday volatility and momentum, looking to capture a quick gain. Someone using SoFi Active Investing with a longer-term view might see the depressed price as an entry point for a high-risk, high-reward position in their portfolio. Meanwhile, a more conservative individual using Fidelity ETFs or Fidelity mutual funds for their retirement account would likely have zero exposure to a company this speculative. The tools available from the Fidelity mobile app to the advanced systems at Interactive Brokers all cater to different strategies, but none of them can eliminate the fundamental risk of a company that is still trying to prove its business model. Now let's think about the future outlook, framing it through our expectation versus reality lens. The bullish expectation is that today's jump is the inflection point. It's based on the idea that Nuburu has just signed a deal with a major automotive or battery manufacturer, one that provides a clear line of sight to significant recurring revenue. In this scenario, the company secures its financial footing, scales production, and its blue laser technology becomes the industry standard. The stock would, in that case, have substantial upside from these levels. The technology is real and serves a growing market, which is a powerful foundation. This is the narrative that those buying the stock today are betting on. The reality check, or the bearish case, is that this is a temporary relief rally in a long-term downtrend. The underlying issue of cash burn hasn't been solved. The company may need to raise more capital soon, which would likely mean issuing more shares and diluting existing shareholders. Competition isn't standing still either. Larger, better capitalized industrial laser companies are also working on solutions for welding reflective metals. It's possible that a competitor with a more established manufacturing and sales network could develop a good enough solution and squeeze Nuburu out of the market. In this reality, today's 37% jump is a fantastic opportunity for trapped long-term holders to sell into strength and reduce their position, or for short sellers to re-establish their positions at a higher price, betting that the gravitational pull of poor fundamentals will eventually drag the stock back down. What are the key catalysts to watch? The first and most obvious is contract announcements. A press release naming a major OEM as a customer would be a massive validation. The second is their quarterly earnings reports. We need to see a clear and sustained trend of accelerating revenue growth combined with improving gross margins and a slowing of cash burn. Anything less will be met with skepticism. Finally, watch for any news on financing. Securing a non-dilutive government grant or a strategic investment from a major corporate partner would be far more bullish than simply selling more stock on the open market. This is a critical time for the company. They have a product for which there is a clear and growing need. Many people who own Tesla stock are indirectly betting on the success of technologies like this that improve battery manufacturing. Considering all of this,